My name's Scott Young. I am in Group 11. Some of the difficulty I did have in preparing for this was I don't know where everybody's level of expertise is. I don't know if you guys have $100,000 CFOs on your team that sit down and you have a meeting every month and you discuss stuff, or if you guys have got a glorified bookkeeper who keeps everything on QuickBooks. And to try and prepare for both of those was fairly difficult. So I'm going to try and hit a little bit down the middle. I am a senior audit partner. I've been an auditor. I audit for-profit companies and have for 27 years. I'm presently a senior audit partner. I run the audit practice of a 50-person firm here in Irvine. Point of view. The point of view I've taken is you're a business owner, you're a CEO, you're a branch manager, you're whatever you are. It's the end of the month, beginning of the next month, and your accountant or financial person has come into your office and said, here's the latest financial statements. Plopped them on your desk, turned around and walked out. And we're picking it up right from you reach that hand and you grab those financial statements. And now this class is starting. When we talk about financial statements, what are we talking about? What should we be looking at? And it's amazing how many clients I have who don't understand which financial statements they should be looking at and the difference between the two. First, quickly, is a balance sheet. That's a still photo, snapshot at any given point in time. The income statement is the motion picture that measures an extended period of time, a month, a quarter, or a year. I have 5 main points I want to drive home. Really 4. That middle point about break even, just kind of a little added thing. I have 4 main points I want to drive home. And there they are, and I'm not going to repeat them for you, and we're going to start moving into those. These are the things that I repetitively have to talk to my clients about. Just over and over again. It's almost like when I'm preparing to meet with a client, I start with 1, 2, 4, and 5 because I know we're going to have to talk about them. Because they probably didn't do something to address those kind of issues. So you got those financial statements. You put on your desk. Your accountant just turned around, walked out of your office, and you opened them up. And this is what you saw. You opened up the income statement, and you looked at the month, and you saw a loss of $250,000. Here's what I say to my clients. Is this good or bad? Are you happy, content, or sad? Which one is it? What are you? Generally, happy or sad? Probably not too excited, right? $250,000 loss for a single month, you're probably not really excited. Okay, that's a certain amount of data. Now, the previous month, sales were only $1.5 million. The loss, yes, I'm missing a bracket there. Previous month, you lost $650,000. So all of a sudden, does the current month look so bad? No. It changes the perspective. Okay? Now, you guys are a quick study. Okay? You're a real quick study. So I tricked you once. I'm not going to be able to trick you again. So let's do the same exercise a different way. Okay, so we've got March. March doesn't look like a bad month. Sales of $1.5 million, dropped $190,000 to the bottom line. Hey, had a good month, feeling pretty good about myself. So in a vacuum, it looks good. But I made more in February and I made a lot more in January. So many times I see clients have financial statements with one column, one set of financial data. And they are looking in a vacuum, and if it's black, i.e. it's profitable, they think they're happy. And if it's red, i.e. they've lost money, they're depressed. Financial statement should be, fill in the blank. Correct. Okay, that's a good one. Accurate. We're totally not dealing with accuracy in this. That's a whole, man, that's a week-long course. Forget it. We're not even going there. Let's assume they're correct. They must be what? Comparative. They've got to be comparative at some level. They've got to be comparative. Now, compared to what, Scott? Well, I showed you just comparing your current to last month or to the previous month. You can use quarters, years, your budget, the industry. The more the merrier. I call it benchmarking against yourself. And what's the reason? Why should financial statements be comparative? Point number one, you've got to identify trends. And every time I say that, I feel like Craig Kramer, right? Isn't the T12 chart? Craig, if you were here last year, you've read his book. Craig Kramer's all about trends. He said, you got to have T12s. I got to identify the trends. And I'll tell you something about trends and those that use T12. We were talking about it at breakfast, I think the table I was at. 2006 was a pretty good year for most of our clients. Most of America had pretty good 2006s. However, the smart clients realized that somewhere around July or August, the wheels started shaking on the car. Now, the 2006 financial statements and tax returns showed large profits because the first 6 or 7 months were really strong, but they had actually lost money or broke even during the last 4 or 5 months. So the year in total looked good, but those that identified the trends quickly were able to adjust their pricing, were able to adjust their fixed investments in personnel, i.e. some of them had layoffs. But they got those done at the end of 2006 when everybody else was still thinking, I'm still making money, things are still good. Now, in 2007, everybody lost money, and in 2008, everybody's losing money again, so to speak. But the trend, when did this really start? About mid-year 2006. And everybody else would say, it started in 2007. No, it didn't. For most clients of ours in this local area, which is my sphere of influence that I understand, my pool of knowledge, it started about mid-year 2006. So comparative. So your people give you financial statements, and it's just got this year, part of the problem is not you, it's not your accounting people who prepares it, your outside bookkeeper, it's the software programs. It's the canned software programs that you use, the Mass 90, the Great Plains, the whatever you use. Because everybody just uses a default setup, and it says current month, year to date. It's like in January, you get January and January. Because it's only year to date is the same as 1 month. And then you get January in 2 months, and then you get February in 3 months, or whatever you get. That's all you get. It's comparing nothing. So you got to take those financial statements, call your accountant back in and go, I need something new from now on. Here's what I want you to do. And you take a piece of paper and you pencil it out. Give me the last 3 months just lined up. Give me the last 4. Give me something. But don't just give me a current month. You're just not going to learn very much. You're surely not going to identify any trends. Second big point I want to drive home. We all hear the terms top line and bottom line, and I'll borrow from Dr. Henry Cloud, where he talked about, use the sandwich example. If I ask my clients, do you know what your sales are and how they're trending? They'll get there. I say, well, you making money or losing money? They'll know that answer too to that question. But if I ask, what's the difference? What's the meat in between? Whew, they don't know. We, as entrepreneurs, as CEOs, business owners, we have a tendency to focus on top line. I know in our BBL group, we talk about sales all the time. And then we'll talk about the bottom line, but a lot of times we won't talk about what's in between. And that's what we want to talk about here for the next few minutes. Concept of margins. And margins, let me make one, because if you're not in the manufacturing industry, you may already just be throwing up a blocker saying, well, those are for manufacturing companies and I don't have a gross margin, so I'm going to tune out for the next 5 minutes. I encourage you not to do that. I'm a CPA firm. We don't have inventory, but we have labor. And so all of our financial reports are generated to have margin. We call it labor margin because that is our single biggest cost and we can control it. And as revenues go up, our labor should go up, and as revenues go down, our labor should go down. So we measure, when we talk about margin And with our partners and managers, everybody knows, we're talking about labor margin. So don't tune out if you're not a manufacturer or distributor and you don't have inventory. Margins are important. We're going to drive home the point that you need to be looking at everything in between through this example. Okay, we're going to look at top line, bottom line, then we're going to go back. January, $1 million of sales with a modest net income of $150,000. I'll take that month. February, sales go up by $200,000, 20%. Everybody's pumping their fists. Salespeople are having champagne parties. We're celebrating. Oh, net income only went up $1,000. That's a problem. But yet, don't we have a tendency to celebrate sales increases almost more than anything? There was a headline, and I didn't keep it. I didn't keep it. It was like 8 to 10 years ago. It was Newsweek. It was Business Week or Time. I can't remember which one. And the cover was "Top Line Thinking is Killing Corporate America." And I thought, that is so incredibly brilliant. And then I lost it, and I want to get it back, and I want to frame it and like put it in my office because it is so true. I have clients who literally throw parties to celebrate the month of February because there was a 20% increase in sales. Oh my goodness, that only dropped another $1,000 to the bottom line. There's something wrong. And we'll take it out another month. There's another increase in sales, so we're having another party. And in the last 2 months, we've only dropped $11,000 to the bottom line. Okay, there's something wrong there. So this is where I'm driving home point 2. Great to look at the top line, great to look at the bottom line. That's typically where my eyes go. I don't read vertically. I typically go top, bottom, then back into the middle. So let's go back into the middle. Your gross margin here is getting eroded. And that's a problem. And you can see in this example that they've had their top line margin, again, in our firm, this would be labor margin, it's going from 30 to 28 to 27, even though they've had a 30% increase in sales. So they're taking the proverbial 2 steps forward, 1 step back. So you've got to look and manage and understand your margin. Why did this happen? And there's 2 things that drive your margin. It's your sales prices and your cost of your whatever you're selling. Are your costs going up, or did you lower prices, or is it a product mix? But it should be fairly easy for you, not you as an individual, but you as your entity, to determine what's happening with your margin. Second point, something I see very few companies do, nor do I see them do it well. Separate your expenses. Normally what you'll see is your sales, your cost of sales, your margin, then you'll see overhead, right? Or SG&A. Or you'll have them all listed, even worse, right? You'll have them all listed. To get to net income. If it makes sense in your business, separate your expenses into your variable and your fixed expenses. Now, what are variable expenses? Again, in our business, it might be insurance, bonus plan, profit sharing contribution, anything along those lines. Overtime. Generally, as our revenues rise, those variable expenses will rise naturally. We don't really have to do anything. It just kind of naturally follows. And if sales go down, those variable expenses kind of track along with it. Variable expenses, just due to the name, should be tracking your sales levels. Your shipping expenses, your commissions, anything that would rise or fall kind of directly with sales is your variable expenses. Separate those. Because you know what? You can't control those per se. I mean, there's things you can do, of course, but generally they're going to rise and fall as sales do. Just kind of a business axiom. Separate those from your fixed expenses. Now, of course, the fixed expenses, there's things you can do as well, but typically those take longer to fix or reduce or add than your variable expenses do. Your fixed expense, it's your rent. That's the lease on your copier, the lease on your phone system. Your sales go up or down 50%, that you're still writing the same check every darn month. So what happened in this company? Again, top line thinking, hey, we're happy. 30% increase in 2 months, salespeople, give them a bonus. Bottom line only went up 11 grand. That's not a good return on my investment. I invested whatever to get 300,000, I got 11 back in my pocket. That's a trend I just don't want to continue. That doesn't work for me. So I started digging into it. I look at this margin. I get somebody to look at that, analyze it. Okay, is that increase in price of steel, lumber? What is it? Or there are salespeople go out to move product and start discounting stuff, and I didn't really know about it. I need to know. My variable expenses, okay, they ran 5% of sales. It's about what they run, yeah. 5% the next month, okay, makes sense. Just kind of a quick hit. Yeah, I know that number. March jumped up to 7%. Oops, somebody's got to explain that to me. Go back, find out why that jumped up. What happened? And your fixed expenses. Again, you're not looking at percentages now, you're looking at raw numbers. 100 grand in January, bumped up to 125 in February. Oops, got to figure out why that happened. Back to March, okay, it's back to its normal level. We're done. We're just kind of checking through that. This is not a main point. And again, when I was back to point of view, I don't mean to be a downer, but the economy blows right now, okay? And a lot of businesses are really down and really struggling. And so, I'd like to keep everything on the up and up, but hey, we're searching for reality and truth, right? So when I was preparing, I prepared this with a point of view of everybody was in here. Most of the people, the majority of the room, 51% of the room, was looking at this kind of a trend as opposed to this kind of a trend. So I throw in something like break-even analysis. Now, so this follows on point 2. Point 2, we talked about margins and knowing your margins. You can use that same analysis to determine your break-even point. Now, when might break-even point become useful to you as a business owner? Let's say this lovely lady right here is going to open up a second restaurant, a third restaurant, a fourth restaurant in a bad economy. She may want to know, okay, first thing I want to know what sales do I have to have just to break even? Okay? Or you're going to open up a new product line. You got to say, I need a complementary product line. You may say, I want to know how much sales do I need to break even? Right now, I just want to get to break even. Then I'll start worrying about making a lot of money. So break even analysis is useful. And you really only need a few things. All you need to know is your fixed expenses and what your margin is. That's all you need to know. And you can do your break even analysis because you just divide the two. In this example, you take your fixed expenses of $1 million divided by 20%, you would need $5 million to break even. Because the delta of your margin is your cost of sales. So if your sales are $5 million, it means your cost of sales is 80% or $4 million. So you have $1 million margin minus your $1 million in fixed expenses, and you have net income of 0. Let's move on to point 4. 2 more main points to drive home. And I'll hit you with a punchline first, and then we'll do it again again. Profits do not equal cash flow. Let's say it again. Profits do not equal cash flow. And if it's one question / exasperation I get over the phone over the last 27 years more than any other, it's this one. Scott, I don't understand. I'm making money and I ain't got no cash. I hear a bunch of chuckles, see some smiles. It's resonating, right? So let's talk about that, because there's a way to understand that a little more. So here's what I call, you're kind of your quick and dirty. Now, me go over the next couple of slides. I couldn't get it all on one slide. It wasn't going to work. This is just a make-believe month, kind of in the same format, except I made one change. Because what you need on your P&L is you need to be able to pluck out one number. That's called depreciation. So you remember in the previous example, this was $100,000. All I did was pluck the $30,000 out. Now, off your income statement, you need to pull off two numbers to do your quick and dirty cash flow. You need net income. So that was 161. We're just going to set that aside. And we're going to take depreciation expense. Because what we're going to do is we're going to convert this net income to cash flow. So we've already done our income statement analysis. So now we're saying, okay, well, how much cash flow did I generate this month? Got $161,000 in profit. Good. What's my cash flow? How much cash did we generate?
0 to your customer paid.
That's right. 0 to your customer paid. Outstanding. I love that. It's a great, well, not, yes, that's true. I was going to make a smart aleck remark and I won't. You need to look at your balance sheet. We're going to talk about balance sheet in point number 5, but we got to look at the balance sheet. And what we need to do is look at the change. Let me go time out and go sidebar for a second. It's the very last slide I have, and I'm going to play it now. Because I hope you're not overwhelmed with this. Because under no circumstances should you be doing this. Okay? Let me say it again. Under no circumstances should you be sitting down calculating all this stuff every month. Your accounting person should be doing it for you. I started with the example of we're picking up this class. We're starting this class right where the accountant dropped it off, turned their back, and walked out of your office. That's how it happens. That's how it should not happen. What it should be is they should be coming into your office saying, you got 15, 20 minutes, I want to go over last month's results. And they should be telling you all of this. You shouldn't, I'm not under any circumstances implying that you guys need to pull out a calculator and a ruler and start saying, Scott said quick and dirty cash flow. How do I do that again? No way. They do that and they tell you this information. And then you have the reality and you have the truth. And the first couple months is going to be a little bit painful. It's a little learning curve for them. But after that, it's just going to get better and better and better and better. Okay, so don't get intimidated. We're in the me-go thing here now. Don't glaze over and don't be intimidated thinking, I can't do this. I'm not asking you to. I'm just asking you to have others tell you this stuff. That's the main point. What else we need to do is we need to understand the change in accounts receivable and the change in accounts payable. So we need to just pluck 4 numbers, 2 off the income statement, 2 off the balance sheet. And then we start with net income like we've done. We add depreciation expense like we've done. We've got an increase in accounts receivable. It went up, which means, coming right along with what this gentleman appropriately said, I don't got no cash to my customers pay. Well, if accounts receivable went up, that didn't generate cash. On the other side, if accounts payable went up, it means you've preserved your cash because you haven't paid them yet. So then we look at $50,000 and you add those things up, and this month, what was net income again? What was the profit? It was 161, right? Remember the previous slide right here? But how much cash was generated? Only 41. When I say cash generated, I'm missing 2 words there. From operations. Okay, so this is cash from our operations. Now, what this gentleman very appropriately pointed out was, but wait a minute, Scott, I've got my payment for my forklift. I got a 3-year loan, and I write a check for $1,000 a month. How does that figure into this? Guess what? It doesn't. So again, this was a quick and dirty cash flows. If you're going to make it just quick but not dirty, you're going to add another line item here. You're going to train your accounting person. It says, okay, then tell me what was my cash from my financing? Okay, so maybe what? You wrote a $4,000 check. Okay, now I've generated $37,000. So that's where your principal payments on your debt, on your leases comes in to the equation. Yeah, you don't add it to here, but you keep it as a separate line item. Because you really want to know what your operations are doing versus the way you financed the company. Everything that we've done is helping you determine the health of the business via the trends. Obviously, I shouldn't say obviously, we had in our client base, back to 06, talked about 06, we had a lot of clients with a positive number there and a negative number there. Because first 6 months of the year were really good, last 6 months of the year weren't so good, but the end of the year was still a profit. But what happened was people stopped paying. So receivables went way up. So all of your cash was sitting in your receivables. The other thing I found out, and we're going to get to point number 5 really quick, is a lot of people don't look at their balance sheet. You know, we're operations focused. What sales do? Sales up, right on. Bottom line's black. Oh, let's go on. Let's get some more meetings with customers. Okay. Cash flow. Cash is king. Cash is king. So I'm just giving you a tool to work with your accounting people to get us. Let's look at a quick and dirty cash flow. Now, what this is, I'll ask a different question where I thought you were asking, which is, you said, does this show me the health of my business, et cetera, et cetera? Yes, this is one of those tools, but they all are. What would you do with that? Compare it against last month, or the month before, or the month before, or the month before. Again, this is a singular set of numbers. Remember, point number 1 is single set of numbers is okay. You can determine black versus red, positive versus negative, but you ain't going to get no trend. So I ask you, David, are you happy with $41,000 in cash for the month of March? Your answer to me is, depends. Is that better or worse? What's my trend? In a business that starts going south, you can actually be generating more cash than profits. Right? Because you're not making any sales, especially if your business did this. Went up, and now it's starting to go down. All of a sudden, after the apex, when you start coming down, you have a boatload of cash. Because what? You're collecting all those receivables. And you've cut expenses because your business is down, so you're not buying a lot of inventory, and you're just collecting every day. Deposit to the bank, deposit into the bank. You're sitting on a load of cash. But you realize there's a problem. Again, we're driving home the point. Profit does not equal cash flow. Last point. We're in the home stretch. Remember, the balance sheet is a snapshot. It's just at the end of the month, or it's just at the end of the year. It's only that day. The next day, your balance sheet changes. Here's a typical balance sheet, and I just throw that up there. I'm sure you guys know what a typical one looks like. I'm not going to go through that. I just want to show you probably 3 ratios or statistics or calculations that will be good for your accountant to prepare for you. Number 1 is quick capital, especially today. Some people call it different things. They call it asset capital or whatever. Quick capital is just another name. This measures your ability to pay bills in the near term. Kind of an important thing to know today. 3 years ago, we didn't have any clients calculating quick capital. Who cared? Things were rosy. Today, that's an important thing. So how do you do quick capital? Real simple. You take your cash and you add your receivables. Under the theory, you're going to collect those pretty quick, right? You're going to collect those in the next 30, 45 days. And you deduct your accounts payable, and that's supposed to be bracketed, and it's not. Apologize. And you deduct what you think you're going to have to pay in the next 30 or 45 days. And you want this number to be positive. If this number's not positive, you've got a problem. I mean, you've got a legitimate problem. And the only way you're going to get out of that problem, if this is negative, is you're going to have to quickly generate some cash, and or you're not paying your vendors. You're not going to have any money to pay your vendors. So quick capital is a very important statistic for us all right now. I'll tell you what I talk about accruals here, and I try to keep the slide small. Maybe a payroll accrual. You owe bonuses, commissions, things you're going to have to pay in the next 30-ish days that you accrue. Maybe some taxes, payroll tax, sales tax. Those are all great examples, guys. Great. Again, what's the next step? Compare to the previous month. Inventory turnover. Now I am talking about anybody who carries inventory. This doesn't apply to my business or to Philip's business because we don't turn over people. If we do, we have a bigger problem. Inventory turnover. This is the rate that you're bringing something in. So you bring in inventory on January 1. How long does it sit there before it's shipped to a customer? You want it obviously to turn as many times as possible. You want a big number. And again, it's a simple calculation. You take your cost of sales for the month, quarter, year, divide it by the average inventory, beginning versus ending divided by 2. It's just a real easy calc. And again, it's trending. Somebody's going to ask me, is 4.4 times a year good? I'll say, I don't know. What was last month? What was last year? What industry are you in? What's the industry benchmark? All easy information to get your hands on. All right, debt to equity ratio, it measures your leverage. Your friendly banker is going to be more interested in this statistic than any other, especially today. What happened with our banks? Here's what happened with our banks. They had to write down their investment in their pool of subprime mortgages. They had to write them down. They had to write down a value that took away their capital. And their debt to equity ratio went through the roof. So they couldn't go to Wall Street and raise any more money. There you go. I just explained what happened for 2 weeks. It was literally that simple. The banks that went belly up could not go raise more money because their debt to equity ratio got too high because they had to write down all their assets in those ugly little ARM pools that they had. Okay? It's important for you. It's important for every business. And it's just simply total liabilities divided by equity. So if you had $2 million in liabilities and you got $1 million in capital or equity, that's 2 to 1, and you want a really low number. I will give you a general rule of thumb, but please don't go write it in your Bible and treat it as gospel, because it's not, which is in the old days, and we're not living in old days anymore. If you had a debt to equity ratio under 4 to 1, you were pretty much bankable anywhere. If you were mildly profitable and you had a debt to equity ratio under 4 to 1, means you had less than $4 of liabilities for every dollar of equity, you could pretty much get a loan anywhere. Over 4 to 1 still wasn't impossible, but 4 to 1, under 3 to 1, you had banks competing for your business. You were going to get a good deal. Those are the old rules. I don't know what the new rules are. I haven't been through them yet. Here was the big punchline that I already played. It's the last slide, which was, again, don't freak out. You guys should not be doing this. 27 years in the industry, I don't calculate these numbers every month. But obviously we've trained somebody within our organization to generate 1 or 2 page reports that get circulated to all the partners, and all this stuff's already done for us. We just look at it. We just identify trends. You have to know what it means, and you have to be able to identify the trends. But I don't expect you guys to, pull out your glasses, pull out a ruler, pull out a calculator, and pull out your notes from this deal. No. But you do have to understand it.